this, I'm looking at this. Welcome anyway. We're going to talk today about asymmetrical trade hunting. We'll start in a moment. We're probably going to go to the charts, look at what's happened today. Did that last week. I think that worked well. Then we'll go back to the slides, which I'm not showing yet at the moment, which we'll go straight to the charts in a moment. Talk about the topic asymmetrical trade hunting, how to find those decent risk reward opportunities and some of the pitfalls with that. And at the end, we'll do a Q&A. But first, this is your friendly public service announcement for British traders. Here's something you might not know. So if you're trading from the UK, there's a tax-free way to take positions in the markets. It's called spread betting. You don't pay stamp duty and there's no capital gains tax on your profits. You keep 100% of what you earn. It's been around for decades and it's one of the few tax perks that the UK actually offers. If you're still trading CFDs, you've got to ask yourself why, because it's the same spread, same exposure, same leverage, same instruments, but with spread betting, no tax. So for most British CFD traders, you're effectively paying tax that you don't need to, and no one wants to be doing that. And the reason I say this is because I think that a lot of people don't know about it. And the HMRC have just updated their website literally 3 days ago. There's always a concern about, you know, if you're doing it full time, if you're doing well, there's all these objections, and they literally just updated their website, you know, and it says when they've updated it. So I wanted to bring your attention. If you're in Britain, if you're a UK trader, to me, I don't know why you do CFDs. Very few reasons why you do that. I just wanted to mention that because, hey, who wants to pay tax when you don't need to, right? We pay enough as it is. Yes, we do. So let's share the screen. Now, what I'll do is let me share the screen first because I probably have to go to the risk stuff and all that type of jazz. So let me just put you on here. Let me share this with you here. It's been an interesting day, right? Gold swinging around. Good fun indeed. Okay. You should be able to see that. Beautiful slide. Beautiful first slide. Let's get straight to the risk disclaimer and we can get onto the charts. So we're not going back and forth with bits and pieces, making a mess of this. So Paul Tudor Jones, one of the greatest traders around, hedge fund manager. You know who he is. You've hopefully seen the what's it called, 1980, great video, sort of first documentary, one of the early documentaries of following a trade around. It's called 1980. Go on YouTube. It comes up for a while, then it gets pulled by his legal team. It's super interesting. Right, it's just super interesting following a young Paul Tudor Jones phoning in, guy, don't leave the phone. The guy's in the pit running off his guy, don't leave that phone again. If you love trading, love markets, well worth a watch. Anyway, that guy, that dude, he said this: I look for opportunities with tremendously skewed risk reward potential. And he goes on to actually say something about 5 to 1. Now, listen, is that something he's saying at that point in time and the markets change? Maybe. But the point is this, is that it may not be for everybody this. I'm not here to say, hey, you should trade in this way. I'd never do that anyway. It's like, yeah, I've got a couple of decades of experience in the market, so I feel like I can share stuff of value with you. But I know that some traders don't trade this way. However, I think for many traders, this is something to consider. And what we're trying to do here is we're trying to identify trades that have a decent risk reward ratio. So before we do that, let's have a brief look at the markets now, because there's a lot going on. I want to kind of talk through some ideas and thoughts of what has happened, what price is going to do. Then we'll come back to this stuff and we'll carry on with that. Oh, maybe I should have first give you the disclaimer. Of course, you know by now trading is super risky. Margin, leverage, amplifies your gains, amplifies your losses. It can get nasty very, very quickly. And I hate to see people losing money because of inadequate risk management. Losing trade is part of the game. Is something we're going to talk about today, the maths of that. But just please understand, if you're kind of new to trading, or even if you're not, just understand the risk involved in this. It is risky. Don't trade with money you can't afford to lose. Understand how the product works. Understand basic risk management and, you know, as much risk management as you can. Stop losses, small position sizes, gap risk, news risk, all the other stuff. You understand that, and you still want to get involved in trading, then fine. You know, we're fortunate enough to be able to trade with leverage and margin, but just please, you know, get that dialed in before you decide to risk some real money. Okay, so I'm going to switch over now to this. Has that even worked? I don't know. Maybe it has. Yes, maybe it's a bit wide. Let me try and that's on my wide screen. Let me shift it in a bit. I can't even see what that looks a bit better, I think. Okay, so today, gold, obviously, big swinger, massive bar, massive liquidation. It was overdue, right? Very stretched. Do we get continuation? Now, we had this on Friday, and we kind of got bid up on Monday, down today. Is that the trade done? Is there some more downside? Maybe there is. It'll be interesting to see what happens in the overnight session, the Asian session, etc. We can talk about, why this squeeze occurred and all that other stuff, but it's definitely in play at the moment. We may have a volatility contraction coming up. We've had an expansion. We've had this. Obviously, with volatility expansion, as we kind of really had that squeeze to the high side, but it's in play. It's worth watching. Now, let's go to the, no, let's not go to that because that's what we're going to show you in a moment. Let's go down to this. Where are we? Dow, good day today. Took out the all-time highs. Can it hold it? We've still got a couple of hours left. Interesting. Listen, I think that the situation at the moment is this: is that we still have this. We're still in a bull market, right? We had that shudder 2 Fridays ago when Trump tweeted about China. He backpedaled as we expected, and that's kind of the risk has come back onto the market. Risk back on, risk back on. Don't forget, the funds have one eye on the year close. They will be looking at that and they'll be saying, hang on a second, we want our bonuses. We want to see a good time stamp, a good stamp to the year end. And so they will be, do we carry on bid throughout? I know we're early still. We've got November, we've got December, we've got some time, but people will start sort of forward pacing that. So is the bull market still intact? I think it is. We're at all-time highs pretty much. We had a shudder on Friday that we've clawed back. I think the tell was that Friday, right? 2 Fridays ago when we had that close at the lows. What would happen on Monday if we hadn't have gapped up? If you had the good news at the weekend and hadn't have gapped up, I'd have said, hey, maybe we're in for a couple of weeks of selling. We didn't. We gapped up on good news, which is what you'd expect from a bull market. And we've kind of chopped around. It's been very choppy. Today has been the first day that we've kind of resolved a little bit to the upside. We've still got to take out the highs. But for me, I kind of want to see, yesterday was the day we really resolved the upside. I want to see us take out these highs and consolidate a bit. And then maybe we're positioned for another leg. Who knows? I mean, listen, I just take every day as it comes and I kind of look at price. But this is where I kind of think through things. I look at what's holding, what the news has done, and how the price is reacting relative to that. Russell's let everyone down a bit. It was like one of the most aggressive movers a couple of weeks ago, and it's just really sat there. That's really interest rate sensitive, and we kind of waiting. Obviously, the government's still shut down. That may change at some point. But all the indices are in play, right? Apart from the DAX seems to just not be going anywhere. You DAX traders out there must be super frustrated. It's sitting there. It's kind of struggling to go anywhere. We haven't really broke out the range. A little wick to the downside on Friday, bid up on Monday. Can that be the spring and catalyst to get going? But you know what DAX is like? DAX kind of needs to break, pull back to the breakout level, and then go again. One more interesting thing I want to show you was China. Now, I know you might not trade the Chinese market, fine, but the index at the moment, I think, is at a really key level. I've got an alert set if we start to break this, because that brings in this stimulus all-time high they had when they said that we were going to, well, they said we're going to lend companies money that we would underwrite for them to invest, something wild like that. And we saw this massive rip up. That was a great trade back in 24. If we can claw back to that, there may be a trade on there for some of you swing traders or getting involved from a day trading perspective. I want to show you a little bit of my thoughts on gold today. Let's use the let's use this. So hey, what's interesting is this. Things with gold, it's very there's patterns that repeat quite a lot. If you go back to Friday, right, and I think this is done, so is this a moot point now? Possibly. If you go back to, where was our big sell-off on Friday? Last Friday, wasn't it? Last Friday. Here we go. No, one more. Where are we? I should be looking at the futures. Bear with me, gents. Ladies and gents, bear with me. Let's go back here. So this was the Friday we had the sell-off, right? This was the 9th. That's the one I'm looking for. A long time ago. I thought it was closer than that. Of course, it's the 9th because last Friday was this. So look at the pattern. The pattern is this. When we start to hold below this kind of VWAP area. VWAP is very useful, I think, for framing how price could react. If the market has been constantly trading above VWAP for most of the days leading up to that, or very, very little time below VWAP, it tells you who's in charge, right? And when price starts to hold below VWAP for for a longer period of time, that's telling you that the buyers aren't stepping as they have been. Now, gold is a very unusual scenario. I get that, I understand that. However, it's something to think about when whatever instrument you're trading, that if the kind of previous price action differs from the current, if there's a theme like, hey, we're always above the VWAP, we often get bid up with below VWAP, or the opening print, whatever you use as a sort of marker, if that changes, then there's something there to be listened to. And often that is an indication that sentiment has shifted, and you might be like, well, the trade's gone. Well, no, it hadn't, because very often you get that final few hours to position for maybe a breakout, for an extension, for that type of stuff. Now, listen, I know I'm going back in time here and looking at gold, but I think it's relevant now for if you're looking at stuff like DAX, if you're looking at stuff like, NASDAQ, how has it behaved previously intraday? Mapping that out, looking at a piece of paper, and then saying, if I'm looking for a break for highs, two highs, should I say, if I'm looking for a breakdown, if I'm looking for X, what would I want to see as the day develops to indicate that could potentially happen? Hey, I'm aware of it. I'm looking for it. Hey, this feels like it's changed. It feels like it's shifted. Can I now position for an afternoon breakout, pushing the market to fresh highs, talking about the NASDAQ, talking about Russell, Dow, etc. Or are we in the same type of holding pattern as we have been, in which case maybe you leave it, or maybe you just trade it as you normally would. But I think that's an interesting, even if you haven't traded gold, it's interesting to study the shift and how the shift, even if you weren't trading the early session, the sentiment shift, how that then becomes clearer in the market if you've already mapped out how the trade or how the market price action happened beforehand. But that makes sense, because it's such a valuable skill, I think, for traders, is to really see when things are shifting from the norm, because if things are shifting from the norm, it creates opportunity. And in the case of gold, obviously people are much more time sensitive than price sensitive they were then, as they are today. They want to just get out of their long, the shorts want to press hard. There's much more now. And that's when we can thrive, right? That's when I believe we can create decent opportunities in the market. Okay, hope that's made some sense. Let's go back to the screens. Okay, so let's talk about this asymmetrical risk reward ratio trading. So let's turn off the tab audio. Okay, so the big idea here is that I think there's two levers that you can pull as a trader to really improve your trading, and the positive expectancy comes from these two levers. And I've talked about these before. You've got two knobs, if you like. You've got win rate, i.e. the probability of success. So, if you take 10 trades, if you win 5, lose 5, you've got a 50% win rate. Win 9, lose 1, 90% win rate. You get the idea of that. And the risk reward ratio, which is how much you're risking to make X. So if you're risking $100 to make 200, you got a 2-to-1 or 1-to-2 risk reward ratio. Sometimes the kind of terminology, you mix it, match it, but very often there's very few times where you're risking 1 to make a quarter, right? You're kind of, most people are trying to say, I'm risking 1-to-1, 2-to-1, 3-to-1. That means you're risking 1 to make 3, right? Just so we're clear on some of the terminology there. Now, as a trader, as you develop, I think, and this is why I'm quite passionate about this, is that when I'm kind of driving and trying to improve on the quarter, on the year, whatever it may be, I will put one of these in focus. And I will go back and I'll look at my trading and say to myself, okay, do I want to improve my win rate? Do I want to, is that the dial I want to work on? And that might be going down the rabbit hole of kind of stops, improving my entry, improving the timing on the trade. There's all sorts of intricacies there. Or do I want to improve the risk reward ratio of the trade, of how much I'm making when I'm right versus how much I'm losing when I'm wrong? And so I think we need to focus on both, but from a risk reward ratio perspective, I think that's the bigger lever to pull. That's the one that I think, if you get it right, and I'm talking about some of the fallacies and some of the things about, actual versus, potential and all this type of stuff. But I think if you get it right, then things start to improve quite quickly if it comes into gear versus win rate. Win rate's good and it's still important, but I think this is important. So improving win rate, better time, better reads, more precision. Talked about this, and this is today we're going to talk about the second lever, which is the asymmetric opportunity. So just what Paul Tudor Jones was saying. I look for places I can risk 1 to make 5 was his actual quote. And the quote I shared with you is he always looks for these asymmetrical risk reward opportunities. You think about it, so will all great investors. If you think about Buffett, he always talks about, hey, my downside is this and my upside is this. If you talk about people who invest as like an angel investor or YC, they're looking for the upside of a unicorn and they're prepared to take many kind of small losers along the way. 500,000 here, 800,000 here. You get the idea. Now, so as traders, it's not quite as simple as that, because we shouldn't always be hitting for 6 and looking for the kind of home run all the time, because there's a mental consideration with trading as well. If you're always looking for a 50 to 1 or something, you would probably get one of those a year if you're lucky, right? And your idea is, I'm losing and get a winner. So there is a sweet spot to be had, and there's a real world as well, like what you're trading, the expectations of the market, all that type of stuff. But I think there's some adjustments we can make. So I share with you today some of the kind of low-hanging fruit potentially of how to do that. So just running through the maths very, very quickly, our expectancy is that formula. So effectively, if we win 40% of the time, if our win rate is 3 to 1, we've got a positive expectancy. I think it works out at 0.6 every time you trade is your expectancy from that. And what we're trying to do here is we're trying to say, listen, we don't have to be right all the time. But when we're right, we want to make as much as possible. Now we can go another leg into this and say, we're adding to trades, doing this stuff. But I want to keep it simple today in that, how do we find those trades? Because it's not just a case of I'm looking for 10 times what I'm risking. It doesn't work. We need to be smarter than that. And thinking back, constantly thinking in your head, yourself as a trader, like, hey, I know these 2 dials need to be adjusted. I know I need to improve these. And so, when I'm working on my trading, when I'm journaling, when I'm going through my trades, my executions, the trade I didn't take, how is that helping me move the primary goal of the win rate, of the average win, of the expectancy? Because that is ultimately what's going to affect your bottom line at the end of the quarter, the end of the year, the month, whatever it might be. Okay, so something to point out here. Now we kind of know risking 1 to make 3, 4, 5, whatever it might be. We've got to be careful here that we don't go into theory, because many traders will go, well, my risk reward ratio on this trade is 5 to 1. How many times are you really getting 5 to 1? Yeah, maybe you're coming out, you're putting a stop up. We live in the real world, guys. We move stops up, we manage trades. Very few traders have a binary. I get stopped here at 1R. I have a target here of 3 or 4R. I don't know any traders who actually do that, right? Because there's a dynamic nature to the market. The trade evolves as the price goes in your favor, right? Then the risk reward structure evolves. If it's kind of 1R away from your target and it's gone 3R already, then now you're risking 4R. If your stop was 1R away initially, it doesn't make sense. You kind of screw it the other way around. So yeah, that's a complete separate subject. But what I wanted to say that is that, we're thinking in terms of what's our sort of average risk reward ratio. What's not a theoretical, I've done this, it's a 10 to 1. It's like, no, what's actually happening in the real world. And journal will help with that, logging down stuff will help with that. But to get to that point where we increase the actual number, so the real number that we see on our history, on our blotter that we've worked out, or a journal does it for you, to do that we have to try and target decent trades that have a good reward based to the risk. And to do that, we need to be in the right conditions, right environment, right type of trades, I believe. This is why I'm going to share this stuff with you today. And so, not all trades are going to go to target. There's not a golden bullet that we just go out there and just look immediately for 10 to 1s. Wow, make it 15 to 1. Hell, man, make it 50 to 1. Why not? We're not trying to do that. We're kind of making a framework here to get you in trades with the right potential. If you're hunting these trades that have the asymmetry, of course, they're not always going to go to target. Of course, they're not always going to go full target, might go half target and come back. But the point is, if you're in the right trades at the right time with the opportunity, a little sprinkle of luck now and then, that's the traders, we have to have a little bit of luck, right place, right time, right positioning. That then allows you over time to improve that risk reward ratio on the trade, the average risk reward ratio on the trade, the average amount you make versus the amount you lose. And that, just tweaking that slowly and slightly, has a massive impact, or potentially a massive impact, on the bottom line. So why do we look for this? Why don't we just sit here and go one-to-one, one-to-one? Now listen, I know traders who do that. And if you're a trader who's doing well, going one-to-one, one to a half, risking one to make, and you've got a really high win rate, you carry on doing that. I'm never going to tell another trader how to trade if stuff is working. It's like, do more of what's working. I'm a big advocate of that. It's working for you, more. Keep going. Don't even get distracted by any stuff. But if you're the type, and that's very, those traders are few and far between. I can think of a few off the top of my head who do that well, right? And that's a very distinct skill set. It's very niche, generally very active. There's a different edge requirement there. But for most traders, going down the rabbit hole of improving your RVR is, from a mathematical perspective, improves things. So from a pure, if your pure logic brain is on, you go, well, look at the numbers. Like, I don't have to do anything else. I just have to be a little bit better at holding for a little bit further. Now, I appreciate there's a psychological impact of this. I appreciate that. And we're not going to dig too much into that today. And I'm not forgetting it. But I would kind of look at operations here, look at the operational side of the risk reward ratio, stretching those targets, look at those good trades. You don't have to be right often, you can hold through noise, you don't panic on the first thing against you. So the point here is that I think for many traders, this helps with conviction. Speaking to a trader, when was it? Last week. He looks for generally 6R on his trades, and he's very methodical, he's very careful. Obviously, he's got an element of discretion there. But when he has, and he moved his stop off as well, so when he has a half R loss, maybe a couple of R, he knows that he's just one decent trade away from recovering all of that drawdown and making himself green again on the week or on the month. Right now, I know it's not for everybody, but there's a certain calmness that comes when you say, you know what, my win rate's pretty good, and actually I'm pretty good at finding these 5R, 6R trades. I can be calm, I can be patient. I don't need to fight the market. I just need to be smooth. I need to be relaxed. I need to just wait for that opportunity to present itself and position accordingly. So I think there's a certain piece to that. And I say, listen, all traders are different, right? I don't know. I've worked with hundreds of different traders over my time, and I've seen hundreds of different traders, from very, very, very good traders to pretty bad traders, right? And all in between. And one thing is clear, that personalities are all different. So you find what works for you and kind of push it as far as you can. So where to hunt for this sort of stuff? So I think that let's get back to the weeds and the operations side of stuff here. So if you're thinking that you're in charge of, let's say you're running a trading office, right? And you're in charge of, you've been tasked with improving the traders, and maybe you're one of them, the risk reward ratio. So where would you start? This is the question, and I'm a big believer of asking questions. Like, very often, if you ask yourself a good question, you automatically work through the answer. And so rather than saying, this is, I want to think about this, I want to think, it's like, okay, well, how would I solve this? How would I get to this? And so something where to look, that'll be your next question. Like, well, where do I find these trades? Now, the wrong approach, I believe, is just to go, I'm just gonna make sure I just have my wide in my target, because the market's not like that. You and I both know the market moves in rhythms. The market has a general expected range on the day, a general rotation it's going to stick to. It's like we're looking at the kind of some of the charts before. There was a certain rhythm to the market, and then it shifted, right? So I think I'm going to look at the charts in a moment, by the way, to kind of visualize some of this stuff that will help. The key support resistance of failed breakouts, I think, traps or reversals, either Wyckoff spring, fake out, pullbacks into some sort of structure with an obvious level where the trade is no longer valid. And again, I'll show you some examples in a moment. I think that's where skew hides. Where it doesnn't hide, and where I think the traders go wrong, and listen, I've made every single mistake under the sun over my journey, so you wouldn't be the first to do this, is when you're in the middle of a trend, right? You think the market's going higher, you're trying to finesse it, you're like, is my stop got to be wide? That's very difficult you know, when you're in a kind of low grinding environment, to find that asymmetry, to find that multiple risk, unless you start going way out on your time frames and going, well, I'm going to hold for multiple days, multiple weeks, you know, that becomes harder. Not impossible, nothing's impossible, but some stuff is. But you know, from this perspective, it's not impossible, but it's very, very tough. If you're kind of a day trader, a couple of day swing trader, you want to kind of keep the time frame the same. You don't want to start changing the way you're trading just because you're hunting for these higher reward trades, right? If you're a day trader, you don't want to start holding trades for a week, because that's going to, you know, mess up your mind. You want to still stick with the time frame that you're working with, but you want to try to find the trades that have the potential to kind of do 2 or 3 or 10 hour if you kind of get a right place, right time. You don't logical stop miles away, and you'll see in a moment how small adjustments in stop make a massive difference to this. When your targets are unrealistic. So I did a webinar a while ago on average true range, right? Very simple indicator. But it gives you it gives you the average range. If you're not a daily chart of the day, weekly chart of the week, right? And very often that's going to stay relatively stable. You're going to have a relatively stable average true range. And when volatility spikes, depending on what setting you've got, if you've got a 10-day, 20-day, whatever, you know how this works, then it's going to adjust. But the thing is that many traders will say, well, I'm a day trader, I'm looking for this as a target. And you're like, well, the range is $500, let's say. The market's already done 450, and you're looking for another 200. Like, and it's a normal type day. There's no catalyst. There's no Trump tweeting. There's no this. Is that really realistic? No. Okay. There's always edge cases. I know there are, right? And as a trader, you have a kind of roadmap that you follow, but you also have some edge cases as well. But assuming it's a regular type of day, if you're saying I'm forcing the fact that I want to get this extension on the market to get my 3-to-1 because that's what I need, then that's unrealistic, right? It doesn't make sense. You need to calibrate to the conditions, and you know, very often traders are trying to look for just too much. They're too greedy, and I'm a big fan of being greedy when the time's right. Yeah, press things, put size on, do all the stuff that gets the returns you want when the environment's right. But you can't want the market to do something that it's not doing. Now, of course, can things shift? Can things change? Of course they can. You have a Trump coming out, whenever it was 2 weeks ago, and just obliterate the market, and it's an unusual day out of nowhere, and then all of a sudden those unrealistic targets become realistic. But that's something to consider. Again, we'll look at this in a moment. And when market conditions are just too flat or compressed, and this is when it comes back to the same old thing, you know, that we all fall into, is the overtrading trap, right? Overtrading when it's just chopping around, because we know why. I'm not going to go down this rabbit hole because this is a massive can of worms on beer all night, and we've done stuff on this before. No doubt we'll address this again at some point. But the volatility low, the environment is not conducive to trade. You are kind of, if you're lucky, hitting singles, but most likely your win rate's low, your risk order ratio is low, you just have a negative expectancy. And that's the thing, like, you know, traders say, oh yeah, but there's still trades there. But yeah, but think, if you did 1,000 trade in this choppy, sloppy, barbed wire, dirty candles, whatever you want to call it, you know, are you really going to get a decent win rate? Can you really read that more than 50-50? You're a better trader than I, because those type of market environments, I can't read stuff. I don't even try to. I've learned my lesson the hard way, as maybe you have. So you're 50-50 if you're lucky. And have you got the ability to put a stop in a decent place and look for 2-to-1, 3-to-1? Probably not. So mathematically, you're on a very, very sticky wicket with that. And so it comes back to, okay, listen, doing the right environment, the right conditions. Now, let's cycle on to our old pal volatility. And I mentioned this many times, and some people email me and say, you know, what do you mean by this, blah, blah. So what we're trying to do very often is, you as traders, to amplify, and I'm glad we're kind of talking about this today, guys, because it's to amplify the potential of a trade. You want to be in a position where you have again, charts in a moment, you have a stop, you have a target, but you're expecting volatility to increase, ATR to increase, to help you get to that target better. And if you align with how the volatility expands, contracts, you know, so, you know, when we're kind of flushing through lows, or more likely with V-shaped reversal off lows for many things, if you're aligning with this, then you can put a stop in when the volatility is X, and your target and your exit on a profitable trade, or hopefully a profitable trade, is going to, when the volatility is maybe 1.5x, 2x, 5x. And so, of course, you know, 1 minute candle or 1 10-minute candle is going to be way more than it was when you were in the trade earlier and when it was at its max risk. So you can use volatility to your advantage and kind of front run volatility expansion by, you know, we saw this on, you know, gold. When gold goes through those lows, just poof, just floods through. If you're short on that, you want to use it to your advantage and kind of cover into the low prints. You know, we see it often with those early fake outs that we would get very often at the open on the US indices, that would kind of fake out, pause, and then just blast back to the high side. You know, that volatility, pause, and then expansion, you know, and again, some charts in a moment, but this helps improve the risk reward ratio of the trade. And that's where I think, you know, £1 of risk can start to become, you know, 3, 4, 5, etc. A word on stops. So a lot of traders, you know, we fall into this trap. Like, I want to trade more size, and I'm not comfortable with the risk that comes with that. So what I'm going to do is I use a tight stop. And I think we're all going to smile and nod when we say we've been through periods where we just had the death by 1,000 cuts syndrome. I've got a tight stop. I think I'm de-risking the trade. You're basically just giving money away. I'll put it 5 ticks away, 5 points away, 5 pips away, 10 pips away, whatever a tight stop means to you. And you do it because you want a decent reward on the trade. I want to risk £500 and I want to make 2.5. Okay, well, how would I do that? Well, I'll put my stop tight. No, we know that's not the right thing to do. We want to not put the stop tight for the sake of it. We want to use logic, and we want to have a place where the stop is correct, where the thesis of the trade is no longer valid. Looking for that V-shaped reversal, it shouldn't go back through the low. Looking for the breakout, pull back to the break level, it should test, it should go again. You know, the logic of the trade, want the VWAP to hold, it should hold, right? If it doesn't, then the thesis is invalid. Now, this is where we kind of want to be smart, because we want to use a stop that's sensible. We want it as tight as we can. Listen, we all want it. We all want to make as much money as possible, the least amount of risk. That's the job, right? It's the job of a trader. But we've got to be careful we're not going down the rabbit hole of overdoing that. That's our objective. Of course it is. That's what we all want. So we're all into trading. Least amount of risk, most amount of upside. Beautiful, perfect. However, we can't go into a trade and expect and force our method of de-risking it, i.e. a tight stop, when the market rhythm and structure is just simply not offering that. You know, so I know we're slightly deviating off track here, but you really want to remember, if you're hunting for these high risk reward trades or potential high risk reward trades, it's not about a tight stop on for your variables and your requirements. It's what's the tightest stop I can use for the conditions and the trade thesis that I have. And sometimes that's wider than you'd like, and we'll look at it in a moment, but that sometimes ruins the efficacy of the trade, ruins the structure of the trade. What can you do? You have to wait till price comes a little bit better. And every good trader knows sometimes you get a trade that you want to take with every fiber in your being, and every bone wants you to pull that trigger. I know it's going higher, but you look at it and you go, man, I've got to risk this. In reality, I've got to risk this. And what does that make that target? You know, makes it 1-to-1, makes it not even 1-to-1. And you've got to kind of back off. And that's a sign. If you can do that, by the way, I think that's a sign of a good trader that can really think about, where's my stop going to be? Does that make sense? Because here's the trap that a lot of traders fall into while we share some of the charts here. A lot of the traders fall into the trap of, that's where the stop needs to be, but where do I really want it? And so they'll start looking for little nondescript levels. Listen, man, we've all done this. Or a level, that's a level. If it breaks that one out, or lower this candle, and it's really a meaningless, nothing level that no one cares about. And you know that really, if you wanted to express that trade properly, you've got to have a slightly wider stop. But sometimes we don't want to do it, and you know, it doesn't help us. Okay, so let's can you guys all see that? Yes, you can. Okay, so let's talk some actual examples here. Let's get onto the charts as we should be. So today, a great example. A couple of examples on the Dow to show you the difference between where we're hunting for this type of stuff, how the stop matters, etc., etc. So let me cycle back. I don't want to get ahead of myself. So note this down, or I'll note this down in my mind. The Dow, excuse all that mess, we'll get back in a moment. The average true range of the Dow is running at about, let's call it 700 points, right? I've got a 10-day ATR on there. Let's call it 700. close enough for what we want to do. So let's remind ourselves of that. So we go ATR 700 points. Okay, and that's basically saying in a 24-hour period, the Dow has on average, sometimes it does more, sometimes it does less, it's an average than 700 points. But it's a framework, like it's not 3,000 points, it's not 20 points, 700. So we've got a rough idea, okay? So we use that. This is not less on ATR, so don't worry. But we have to think of that in our mind. Now, think about what happened today. So I didn't take this trade, by the way. This just wasn't something that's on my radar, but just for kind of transparency, not to say, oh, look great, this trade, but as a great example and kind of looking back on a similar trade a few days ago and how the context shifts things. So let's imagine we go into the market and say, right, we know the average expectancy of the market range is 700 points. Might be less, might be more. Fine, we covered that. You come in today in a traditional opening range breakout trade. Those you don't know, you bracket 15 minutes, you can do more. You buy the high, buy a break of the high in the first 15 minutes, you sell a break of the low. You basically bracket the high and the low the first 15 minutes, go long if it breaks above later on, or short if it breaks below. Fine, we know this. Now, when you're kind of analyzing and saying, I'm looking for a decent risk order ratio trade, and you come into the trading day today, you go, okay, how much range have we done before we come into the market? Well, we've done 182 points. Now, okay, we're going to look at a context and say that the Monday was a big range day. So maybe we're going to have a little bit less than the average, but we're still expecting there's going to be another 300 points in that, right? We've got to be at least 500 points. So we go, okay, that's interesting. So there's some more mileage potential. We have got potential if we can get a trade right and we can structure a stop in a good way. There is, in theory, more room to breathe. Now, it could go to the downside. Of course it could. And we've got to stop for that. But let's assume we've got to make some assumptions with trading. Trading is about making the best decision we can with the limited knowledge we have. And let's say we frame this opening range breakout trade. The first 15 minutes was here. So from here to here, let me zoom in a little bit for you. Here to here, there's our kind of reference point, right? And so we go, okay, we break out from the high. We've got a 100-point range. We'd put our stop just under this low, right? Got a 100-point range. Now, in this scenario, if we're hunting for a decent risk order ratio trade, do you think there's potential for us to get 2-3R on this trade? Answer, yes, because the environment is right. We haven't yet done a big range. The range and the stop, and by the way, I should clear this, hopefully you guys maybe know this, but a stop goes under the opening range low if you're taking a breakout. So you buy here and your stop goes here. So your stop's going to be 110 ticks, something like that, right? You buy here and a breakout here, your stop goes below the low. If it broke to the downside, you take a short. If you're trading it correctly, systematically, maybe you wouldn't because yesterday was a trend day, but you get the idea. Now, if you are here and you're saying, okay, I'm looking for high risk order ratio trades, you would map out the market and say, as a day trade, can I expect to get 3 times my risk here? And the answer in this scenario is yes. Scenario in the moment, the answer is no. But the point here is if you are hunting, let me use this here. If you are hunting trades that have this potential, right? This is how you come up with the ideas. You go, is it reasonable for me to expect a multiple of my risk on this particular trade? Because if it's not, you need to decide whether you've got a decent, the other lever is high, i.e. I'm putting a decent probability of success on this one. But let's fix, for example, okay, you were thinking, okay, I want to go to 3-1. If you did this, you had a 100-point stop, 107-point stop, which would be the traditional stop for opening range breakout. Where's your target going to be? It's going to be up here, and there's the risk order ratio, and you use trading view 3-1. It happened to be that was the all-time high, by the way, that little marker there. But the point of this is that you could look at that and say, is it reasonable for me to take this trade? And you could look at it and say, is the probability of us breaking the upside 50-50? At least 50-50. I would think it is now. We've got hindsight bias here, but bull market, we had a good run yesterday. I'd say 50-50, right? Wouldn't you maybe put more on it? And then you say, well, if I'm risking 100 points, is there a chance of me getting 300? Is it reasonable? Well, yeah, because the ATR is not yet done. You've not yet done the ATR. You've got plenty of room left on the ATR. So now you're kind of, rather than just stabbing at it, you're kind of lining things up and saying, yeah, there is potential to me a good, decent probability. All right, it's not going to win any awards, but I don't need to, because actually I can structure it 3-1 or 2-1. And that's not, I'm not asking a lot, because fortunately the thesis of the trade, if we're opening range breakouts, it doesn't break below the low of the range, there's 100 and something point risk. That's the actual structure of the trade. That's the thesis. I think it's going to break out and not come back. Fine. You put that in a box, wrap it up. That's done. Now my expectations, are they reasonable? And in this case, they were. So you can see how, you know, this makes much more sense as opposed to this. Let me show you this. Very similar scenario, right? But okay, coming into I made some nice little notes for myself. Isn't that handy? Coming into this day, right, which was 17th of October, so the Friday, we really sold off in the Asian session, European session, and then we kind of recovered. Now, the open, if we're talking about the opening range breakout, let's do exactly the same thing. We're not trying to be smart here and cherry pick stuff. We're saying we'll take exactly the same strategy, the opening range breakout, but map through the trade together in a same market, same sort of time, but slight context difference. And do we still expect to get our 3-1? Let's look at it. So we've already done, when you come into the open here, oh sorry, the open is 230, right? You start to frame out the range. Okay, you frame out a 50-minute range. We talked about this. You take a break above the high, you sell a break below the low. Now, once you frame that out, the range is on the day is already 822 points. You know, when you're talking about the high of that, actually, let's not here. There's the high there. Let's be correct with this. The high is here, right? So you've already done 771 points. What was our ATR? It was about 700. So you look at this and you go, okay, if I was to take the breakout of this trade, I have got to have a 300 odd point stop, right? I've got to kind of go just below the low here. I've got to have a 300 point stop. Okay. Now, to get a many multiple of my risk, what am I going to look for? If I'm looking for the same 3-1, I'm looking for a significant move to the high side. Let's map it out exactly as we did before, right? So we mapped out here. We put our stop below here, and we go, okay, we want this to go to 3. There we go, right? So that's going to take the range on the day up to a whopping 1,700 points. So is that something that's feasible? Could it happen? Yes. Is it likely to happen? No. And so as a trader who's trying to align with conditions, is the opening range breakout trade on this day something you want to shoot for a decent risk reward on? No. Now, is there another decision of, okay, I think it's a really high probability, I'll take it, I'll do this? Maybe. But if we're just looking for hunting for high risk, high potential risk reward opportunities, the structure of this day is completely different from the structure of today. And you can see why, because our expectations, we were expecting too much to have a 900 point target and an arbitrary thing to have our stop in a place where the thesis is no longer valid. It does not make sense. Now, if you want to extend your time frame and say I want to hold for multiple days, I think there's a reason to, then fine, that's a different commercial decision to make. But if we're hunting for trades that have a decent expected value, then this is probably not it, despite all the stuff that goes with it. Now, can we trade it other ways? Of course we can. Can we trade kind of pullbacks to this? Can we trade another strategy? Yes, absolutely you can. But we're still looking through the same lens of, does this strategy allow me to risk X to make 2X, 3X, 5X, whatever? If it doesn't, then the question is, do I still want to take it? If my objective, going back to the first point, if my objective is to improve my risk reward ratio, my average risk reward ratio on the trades, and ultimately improve my expectancy. A lot of long words there. I'm a trader, man. It's been a long day. Okay, so hopefully that makes sense. Let's do another example. DAX, another classical pattern that you might take. You trade a reversal, goes through the lows, comes back up. You take a long as it comes back through the lows here. Again, this is kind of textbook stuff. There's nothing fancy. I'm not sharing anything revolutionary. And you might say, hey, and when was this, by the way? Tuesday 14th. You might say, okay, to take this reversal trade, and it comes back through the prior low. So you kind of goes back and you kind of taking it here, if that makes sense. Your stop's going to have to go below the current low, right? That if it's a reversal trade, it shouldn't go back to that point. Fine. If you put it tighter than that, you know, the thesis is slightly different. So if you did this, you might say to yourself, my target, where's my target? VWAP. Great. Great reasonable target. I don't think there's anything unreasonable about that. So you look at this trade and you say, okay, I want to take this trade here. I'm going to target VWAP. You've got a 1.4 to 1. Now, you might be okay with that. And you might say, yeah, you know what, I'm happy to do that. But understand that if you start looking for 3 to 1s, etc., you might be asking a bit much. Now, it did continue, and we're not trying to be cherry pick stuff and use edge cases, but if your thesis was a pullback to VWAP, and you were structuring a trade like that, and you'd be like, well, is that really what I want to take? And so, thinking about where the target of the trade is, what's reasonable in the amount of time you've got left if you're a day trader. What time was this? This was sort of midday-ish. You've got some time left. Now, if it's a little bit later in the day, you might be like, no chance. Or you say to yourself, yes, I'll take this, but I can't kind of shoot for the stars here unless I'm going to use a day trader's stop with a swing trader's target and adjust and hold trades for multiple days. There's a context issue there, there's all that type of stuff. But there's very different. There's a very different type of mindset and approach you've got to have when you're trading this type of thing. I mean, listen, if you took this, let's say you were really aggressive and took this ignition bar here, right? Ignition bar flows, and then you were targeting your VWAP, all of a sudden that becomes valuable. And so you can see how you adjust stuff. And if you're trying to improve your risk reward ratio, you might not take that classical 1, 2, 3 type pattern because, do you give it, unless you gave it a good weighting of more probably success, which is you're stabbing in the dark anyway at that, you might not want to take it. Now, if there was a catalyst there and there's other stuff that had more potential, you probably could look for more. Okay. Let's talk about breakouts quickly. Listen, we've seen that the breakouts, very often I think if you're hunting for high risk, potential high risk reward ratio trades, unless you're in an unusual condition like gold, for example, or silver, or something that's just been absolutely one-way street, not looking back, that's different, right? You're adjusting to context. Many traders think, well, breakout's going to give me what I want. Now, evidence here, if you're trying to align yourself with the context and the rhythm of the market, NASDAQ futures here, every 15-minute breakouts pretty much failed. We've had a couple of you have to be quick on this short one here. This one's just about work. But look at this. Breaks through the prior day's high, nothing there. Breaks through the prior day's low, nothing much there. High, nothing much there. High, nothing much there. Low, fake out. You've got something here if you were quick. The point is this, is that if you are thinking, what do I want to trade to get these risk reward ratio or potential high risk reward ratio trades, this is just my feelings on this. I think things like reversals offer the most opportunity. Now, you may disagree, you might have other stuff, that's fine. I'm not here to tell you what's right and wrong to trade, but unless you're in the right environment where the market is a one-way street, there's a massive short squeeze like there was potentially in silver and in gold, and you think if this breaks it's going to absolutely fly, be very careful trading breakouts. They can seduce you into thinking you get this volatility expansion, which you do for a short period, which is great for kind of coming out of a trade, but actually use it to your advantage. Many people will trade and buy this breakout here, and where's your stop got to be? Well, it's got to be kind of quite a bit under the breakout, because often markets comes back and tests and wicks, so you've got quite a wide stop, and then you're expecting a really big kind of move above it. It can happen, fine, some conditions are right, but just I wanted to mention it that breakouts, they're not the same as they used to be, and the environment has to be so good to really get those massive risk reward ratio trades on traditional kind of prior high breakouts, something like the opening range breakout or something else a little bit more finessed. But if you're trading like a break of high, a break of low, you're very careful, man. This stuff really, you kind of you're skewed the wrong way around. You got the stop's got to allow for the volatility of the break, so it's quite wide, and then that increases obviously the risk, the structure of the trade. You're kind of looking for really big extension there. So being more finessed by the pullback, this type of stuff, versus something like gold, of course, where the context matches, and it's just been an absolutely one-way street, ripper, complete demand coming in. You align with that and say, well, I don't mind taking the breakout because I can use daily ATR as a stop. I'm looking for a 3-day move, for example. If you're a swing trader, that makes sense. And so my point here is to, hopefully with all these many examples, is to understand the context of what we're trading. And, if you are looking for the risk reward ratio trades, what's reasonable? What's a reasonable thing to do? I happen to think that if you're trading reversals, the earlier you can get on a reversal, the better it can be. That's why I'm a big fan of ignition bars. I've talked about those before. Some kind of indication that things are changing. Bull flags, fine if you're in on early, but again, I prefer to have that on a reversal with a bull flag that's got some potential upside, fill in the gap, taking out the VWAP, etc. I think and this is the problem and the trap that a lot of traders fall into, is to force their their requirements on a market that really isn't in the right conditions for it. Okay, let's shift back to the screen. Share something else. Yes, asymmetrical trade hunting. Oh, a GoToWebinar makes it so difficult. Right, so context still rules. Let's wrap this kind of up and go through a few final things that I think are important. Context is king, guys. We know it is. If you were short in gold today, you were getting away with being an absolute awful trader because the context was right. It was a complete liquidity rug pull. You were fine. You were short in gold in that run up. You were getting your face ripped off. Context matters. If you were trading breakouts in the last week on the NASDAQ, you were getting your face ripped off again. If you were trading the ranges, perfect. So I know it's easier said than done, but it matters so much. And if you're hunting for these decent potential trades, try to make sure the market structure is right. Are you in a trend? Are you aligning with that? Are you trading a reversal back in the direction of the trend? That's got way more potential of doing a 3-to-1, 4-to-1 than a short trade against a trend, gold withstanding, because obviously it's a different scenario. It's more like a parabolic short trade than it was a kind of trend trade, right? What's the range? Was there some sort of squeeze happening? Is there some sort of volatility expansion? Is there some sort of contraction? What's the catalyst? News, data, positioning. I don't want to go sound like an old record, broken record. An old broken record, let's say, but context is so key. And a good context, you can be a little bit poor with your entries, and you can get decent high probability trades that will run multiple hours. And that's what we want as traders. We want a high probability of the trade working, or as high as we can get, and we want it to run as much as we possibly can with the market rhythm and the context taken into account, so our expectations are not too high. And thinking like, you do timing, right? You timing, and talk about last week being so choppy. What's the volatility window like? What's the expansion? What's the contraction? Putting that all together to come up with a formula that says, hey, I think I've got a good chance of getting my 2R here, my 3R. I'm not asking a lot. I'm asking for it to go to prior highs. I think I've got a reasonable stop. And that not all trades are the same like that. We know we see a trade setting up. But you look at it and go, oh man, that stop's got to be there. And now my targets, I can't really expect more than this unless I'm holding for a multi-day move. I don't really want that. I've got data coming up. I can't take the trade. I don't want to take the trade. I'm not risking 100 points on this and there's 100 points in it. Not for me. I'll wait. Maybe we get a retest to lows and I can risk 25 to make the 100. That'll be a much better trade. That's why patience is so important in trading as well, guys. Like, listen, we don't have to pull the trigger as soon as we see the trade. Like, where would the trade work? Where would it work where it's still high probability? We're not buying something that it's really slim chance of working, and we've got a decent chance of making multiples of our risk. There are trades that are like that, but I just want you to think about the context, about what you're trading, the expectations that you have on the market, and being patient for those, because the math then works out in your favor. Like, the math works out in your favor. You can take those all day long, and sure, things aren't as linear as that, and you're going to have trades that don't go full direction, and the average is going to change. We talked about that at the beginning. But if you can look for the trades that have the potential, and you believe they've got the potential, and the structure of the trade is sound, then even when they don't all work, and it still bumps up that risk reward, the average risk reward, the expectancy of your trade goes up. So for every dollar you're risking, you're expecting to make X dollar plus whatever it is back, and that's the name of the game as a trader. So common mistakes here are hunting asymmetry in quiet sessions. Listen, I'm all for A to B trade. By the way, listen, I like A to B trades as much as the next man. If I think that the market's just rotating back to VWAP and I've got to stop here, I'll probably put that at a reasonable probability. I'm not going to swing for the fences and start putting max risk allocation on it. No way. But do I think there's edge there, positive expectancy? Yeah. Little A to B trade, little A to B trade. I like them. They're fine. But that's not really going to give your equity curve the boost. It's going to keep your kind of mind in, your eye in, give you a bit of confidence, bump the P&L up a little bit. If you start looking for multiple R's in a quiet session, you're just going to go your way, come back, stop you out. and they're going to be worse. You get frustrated, maybe go on tilt or other stuff. Talked about overfitting our risk reward ratio, ignoring, is it feasible? Is it, has it got, is it realistic? And I'm all for kind of lofty goals and lofty ambitions, aware targets, and a little bit of greed, is correct in trading. But the market is the market. You can't place your demands on the market and wondering why it's coming back and stopping you out all the time. Using stops that are too tight, talked about that. That's kind of curse that a lot of traders fall into, or trap, should I say. Living in the RVR dreamland, I put here. Great. And what I mean by this is, if you always shoot, so I'm looking for 10 to 1, I'm looking for 5 to 1, and you're not getting it, that's not going to move your average. The dreamland of, I'm always trying to hold trades for more. If you're always coming out 1 to 1, whether that's manually, whether that's dragging stops up, however, then your average is still going to be 1 to 1. You've got to have realistic targets that are in the structure of the market and the context. Fine. You also got to have the management on point. It comes with the psychology. Obviously, it's a complete other rabbit hole here. But if your objective is, I want to just move that up a bit, we can't jump from an average RVR of 1 to 1 up to 10 to 1 in one leap, right? And an average 10 to 1 is nuts anyway. But you can make it from an average of maybe 1 to 1 to 1.5 to 1, or 1.6 to 1. And so to do that, you need a few 3 to 1s in there. You need a few that run, and that's a massive difference on your bottom line, with not much adjustment in operations. It's just, okay, standing back on a few trades that haven't got the RVR potential, waiting for a better entry, being a bit more strategic about positioning for that particular setup. That's the stuff that moves the needle, even one here, and then over time that creeps up that average RVR. So you have to hunt for it to affect your average, because not every trader is going to do that, as I said, but it will affect the average by definition of an average. Okay, so takeaway: don't just trade more trades. I think that's a trap. Many traders we fall into of, I'll do more trades to make more money. You know what? Probably just do what you're doing less, in actual fact, but be more precise, be more considerate. Is this A to B? Is this one that actually has a decent RVR potential? Be more selective. When the maths, just think of it from a maths problem. Like, is it 50-50? But actually, I think there's a 50-50 chance of it going 2 to 1. Take that trade all day long. 50-50 chance of going 3 to 1. Take that trade all day long. Now, you could skew it and say, I think it's a 90% chance of 1 to 1, and some scalps are like that, actually, where you've got a real exhaustion flush. You see this, and this is for tape readers, you see the flush, you see the liquidity stall, you're in on with size, and the likelihood of getting a pop up in the next minute is quite high, but you're not expecting a complete trend change. So that's fine, but that's a different strategy to what we're talking about today. And asymmetric setups are worth hunting, because they can, if you get them right, they can kind of paper over a few cracks and a few challenges that we have with traders. It's amazing what a couple of decent 10 to 1s or decent 7 to 1 winners in a month can do for your P&L. Sometimes you look back and you go, you know what, I'd probably be pretty stagnant if it wasn't for those. That's just the nature of the beast, guys. But if you aren't looking for them, your reticular activator is there looking for the right trade with the right environment and the right context and the right target, you won't find them. So something to consider, hopefully this has helped you, is going away and thinking about, how can I improve my RVR? How can I slowly increase that number? And to do that, I need to find these trades that have the potential. And when I see them, look at it logically, you look at your range, your expectations, your context, your stop, your thesis, your idea. Is this reasonable? If it is, then that's when you hold it. And of course, the psychology element there is there, but just starting to look a little bit more for your trades, starting to let the market pay you for being right, starting to let the market and the trade mature. You've done all the hard work. It amazes me, the traders, that doesn't amaze me, because I was myself in 2002 whenever I started. You take a trade, goes your way, you see it come back a bit, oh, I love that unrealized P&L. So you've done all the work of structuring the damn thing. Let it work for you. Let the market pay you for being right. Okay, a few questions, guys, and then we'll wrap it up. A couple of questions here. Mark, that's me. Gary says, thanks as always, Mark. I like breakouts, but agree they are not what they used to be. Need to be very selective. Yeah, you know what, Gary, you know the score, pal. I've got nothing against breakouts, and they work, but they're far the old days of just buying fresh highs. Unless you're in the right environment, you've got to be smarter than that. And sometimes that's letting the market break, pull back, stop the people who took the break and buying those guys, but that's a different kind of game and approach. Felix says, hey Mark, I like the new format. Appreciate that. Yeah, appreciate the feedback. If you don't like it, let me know. If you do like it, then great, you can go into more detail on that. You know, I like talking about the markets. I sit here looking at price all blooming day long. So I love the new format. You don't love it, you like it. I gave you a bit too much. You like it. That's good enough, Felix. The market commentary, very much appreciated. I have a technical question. What's the correct way to anchor the ATR and VWAP for trading American indices? I always thought it should be New York midnight, but I observed you have UK time set. So ATR, I'm just looking at 24 hours. Like, it's just going to tell you the range of the bar, and that doesn't really matter where that timestamp is, right? Because it's going to give you a range of a bar regardless. It's just 24 hour, 24 hour, 24 hours. So that ATR, don't worry about that. VWAP, I like to either a rolling VWAP, so 24-hour session, but more importantly, I think that the best VWAP is to anchor it on the open of the US session. So if you're trading American indices, which you are, Felix, 2:30, which is UK time, 9:30 Eastern time, start your anchored VWAP on TradingView. There's an icon to do that. Anchor it there. That's the most valuable VWAP out of all of them. A 24-hour, it's fine, but I really only care about the regular trading hour session, US session open. Everything's open, the options are open, the stocks are open, this is open, that's open. You know, you've got all sorts of stuff going on. Liquidity's high, you know this. And so that to me is the real VWAP that algos are looking at. If you go with if you were an institution using a broker who was using a VWAP algo, they would start that at 9:30 Eastern, and they would run it, and they would use the VWAP from that point all the way out to the day to judge their performance. So I care about that. So that would be my answer to that one, Felix. Okay, ladies and gents, thank you very much. We're back again next week. The clocks go forward in the UK 26th, but we're going to do it at 7 o'clock UK time. So we're on GMT from next week, which is 7 o'clock GMT. It's fall forward, isn't it? No, fall back. Spring forward, fall back. Let's go back. God, I messed you up then. Clocks change on the 26th. It's fall back. So yeah, of course it is, because we have a week where we have a change. Is a kind of another public service announcement. We have a week where the American market will open at 1:30 UK time. Yes, close at 8 for you British traders, and then we'll go back and the Americans will move their clocks. Then we go back in sync. That just screws in my head, because I'm so calibrated. I've calibrated for ages. The 2:30 open, so gym session a little bit earlier, data's a little bit early. Everything's got to be shuffled. So from webinar perspective, yeah, 7 o'clock GMT from next week, next Tuesday. Thank you for joining me. Appreciate you all. Good trading. Keep your risk managed. And I'll see you again. Hope this helped, guys. Bye-bye.